Taylor Riggs in San Francisco. This is Bloomberg Technology. Coming up in the next hour, WeWork's cash crunch. SoftBank taps investment bankers to explore options for the co-working company. It comes as some banks whisper WeWork in earnings calls, and not in a good way. Plus, retail revolution. Former Apple senior vice president and former CEO of JCPenney, Ron Johnson, joins me. His new venture, Enjoy, lets the consumer shop at home. We have the details. And Libra pitchman, Facebook's head of Calibra, David Marcus, joins us for an exclusive interview. We will hear from him live. But first, our top story. WeWork continues to captivate Wall Street and investors. On Tuesday, we learned that SoftBank has tapped investment bankers at LA-based Houlihan Lokey to explore options for easing WeWork's cash crunch. News also trickled out that the co-working company lost its communications chief officer, that's Jimmy Ashey, who resigned last week. With more on the continued turmoil at WeWork, it's Bloomberg's Lena Nour, who has been covering all of the facets of the story. So, Lena, first, talk to me about the SoftBank side of this. They're hiring some bankers to help with the restructuring. What are they hoping to get?
It feels like there isn't an investment banker right now who isn't on the WeWork situation. We have two new ones hired today. We have SoftBank working with Houlihan Lokey, who are restructuring specialists. SoftBank has invested over $10 billion in WeWork over the past few years, and they want to make sure that the assets are okay, that they understand where the leases are, what is the value. So they're brought on to help SoftBank figure out if it wants to plow even more money into WeWork. WeWork, meanwhile, their board has hired Perella Weinberg, another boutique investment bank that has experience in restructuring. They're advising board members on which route that WeWork should take. Should they take a SoftBank rescue package, or should they take a very risky high-yield bond package that JP Morgan is organizing?
So, Lena, you led me right to the next question, because of those two options, what does it seem like WeWork is weighing doing more at this point?
We've been trying to figure out where WeWork's head is at and where their board's head is at. We've reported that they're leaning towards the JP Morgan debt package because it's less onerous for some of the investors in WeWork. For the SoftBank package, if SoftBank were to invest more, I've heard some people describe it as crammed down financing, where the financing terms would elevate SoftBank but hurt the other early investors in WeWork and even some of their employees. So that might be one of the reasons why WeWork is leaning towards this JP Morgan $5 billion debt package. But nothing's for certain. WeWork has said they're talking to at least 60 investors to help put together this package, so nothing's finalized. There is no package on the table, actually. WeWork's bankers are still trying to get it together.
Amidst all of this, we did hear that the communications chief officer, Jimmy Ashey, resigned last week. Is that a one-off situation, or is this, again, more of the broader turmoil that's going on?
It feels like there is bad news every day for WeWork. I know earlier this week there was the story about formaldehyde and the phone booths. Losing a communications officer, though, is no surprise given all the bad headlines of the past few months, and there are plenty of PR advisors out there, I'm sure, to help the company.
Bloomberg's Lena Nour, thank you for joining me. And WeWork also crept into some of the bank earnings calls Tuesday, but not in a good way. When asked about co-working company on a media call, JP Morgan, which is crafting the roughly $5 billion financing package to rescue the company, said exposure to WeWork was, quote, not material. Goldman Sachs, meanwhile, cited a massive loss associated with WeWork on its analyst call.
Our private investment portfolio was also burdened by certain negative revaluations, including an approximately $80 million mark associated with our position in the We Company.
For more, I bring in Bloomberg's Sonali Basak, who is now going to intertwine bank and WeWork for me here to help make sense of it. So Goldman, I think the key there, writing down their investment, I believe, by about $80 million. Do I have that right?
You do have that right. And to be honest, I think it could have been worse. I think that $80 million for Goldman Sachs is kind of chump change. By comparison, Jefferies had a very, very small stake in WeWork, and they wrote down their investment by more than $100 million. That's not to say Goldman did not lose a lot of money on technology bets this year. They had a much bigger write down when you took Uber, Aventor, and TradeWeb all together. So that was more than $200 million in addition to that $80 million on WeWork. JP Morgan would not really give us any color on the size of their write down. However, remember, JP Morgan's exposure was a lot different. Not only was it any sort of principal investment here, they also had funds that were invested in WeWork that altogether made them one of the biggest investors.
Well, Sonali, I want to take a look at sort of JP Morgan's exposure, because when you take a look at some of the bonds, like you said, they were hitting a record low on this, and you have yields now about 13%. So as you tie in JP Morgan's exposure and then, of course, crafting that deal, what is the appetite for any deal that has a 15% coupon or so attached to it?
As you know, 15% is a tough one for the bond market to absorb. It's risky debt, no doubt about it. And the appetite for that, not only for WeWork, but just in junk bond markets right now, is pretty weak at this point of the year, when really the markets overall look pretty choppy. So with that said, it's really crunch time. It's really crunch time for JP Morgan to look out to dozens of investors here that are willing to buy these bonds at a much higher yield, right? Or to get into this debt at a much higher yield. The idea is to compensate these investors here for what they're taking on.
Sonali, you mentioned, as we were talking about Goldman Sachs, not only their investment in WeWork, but also some of the investments in Uber as well. Walk me through that write down, as you mentioned, about $270 million or so on Uber, given it's down 30% from the IPO.
Right. These are mark-to-market investments, and Goldman Sachs has this part of their business called INL, or investing and lending. It tends to be a pretty opaque part of the business where there's not a whole lot of clarity, and I think that investors are going to want more clarity on what's in that portfolio into next year as Goldman starts to give investors a greater sense of what their overall strategy is like. They're known to become a much bigger private equity, private debt firm in the future. And so these investments really matter. They have private equity and debt investments, remember? And so these Uber, TradeWeb, Aventor, this is a big part of their public equity portfolio that they're holding right now. And so it's a very specific part of their holdings. And it did take a real hit, but it just goes to show you these investments are volatile. But investors knew that they would be. Remember, it works for them the other way when the investments are up.
Sonali, quickly, we have a quote here from David Solomon of Goldman Sachs, who was mentioning Apple Card, of course, for all things tech, really highlighting what a big success it has been for them. What do we know about the Apple Card as Goldman continues to try to push over a little bit into that consumer side of the business?
Remember, this is one of the biggest partnerships between a bank and a technology firm that's out there. It just launched. It was only this summer. If you know anyone who has it, it's a pretty sleek-looking card. We don't know anything really about the profitability metrics, but it's something that they say has been one of the best cards, or the best launches of a card that's out there. The credit card space is enormously competitive. Remember, JP Morgan has their own rollouts here and there, but again, the partnership with Apple is quite significant, and it's something that they highlighted as a big win for them.
Bloomberg's Sonali Basak, thanks for joining me. And coming up, where are the laughs? Stand-up specials on Netflix are about to undergo a massive change. Why the company is taking a new approach to comedy. Next, this is Bloomberg. If you're scrolling through your Netflix queue, chances are pretty good you'll see a ton of stand-up comedy specials, but that is about to change. After pouring hundreds of millions of dollars into programming, Netflix is switching gears and cutting back. There's still going to be comedy specials, but just not as many, with names like Jerry Seinfeld and Patton Oswalt. To discuss the shift, I'm joined by Bloomberg's Lucas Shaw in Los Angeles. Lucas, why the change?
You know, Netflix funded really an unprecedented amount of stand-up comedy over the past few years. I think last year alone they released something like 60 or 70 specials. The year before that they released 50 or 60. Some of this was just about banking a huge library so that people had something to come and watch. And now that executives are taking a look at the roster, I think they've realized that maybe they didn't need quite that many, or now that they have that library, they can slow down their spending. And so they will moderate it to a still large number, but not like what we've seen. Because I mean, last year they were releasing more than one a week, and that's just more than most people can really keep on top of.
Well, and it's been a relatively cheap strategy. Is that the right move for the company?
I do think that it was a very effective way of bringing in big talent. Ellen DeGeneres, Dave Chappelle, Chris Rock. You get those names, that's going to make somebody want to come to Netflix and check it out. You know, the company's response when I asked about this was not that they were abandoning stand-up comedy, but that they were sort of re-evaluating or reassessing the comedy strategy. So you'd see more investment in something like sketch comedy. They've released a couple of sketch comedy shows this year. And then these collections of kind of shorter stand-up episodes with up-and-coming comics. And so they were investing in new areas that they thought might also bring in customers. One of the things you have to remember with Netflix is that they're always looking for ways to optimize their spend and bring in new subscribers. And so if they feel like they already have a lot of the big stand-up comedy fans, maybe they see an opportunity to bring in some sketch fans on the chance that that is a different audience member, a different member of kind of the customer base than they've had so far.
This is a company that spends $15 billion on content and programming. Any idea what the content priorities are going forward?
International is the biggest one. They already have a ton of comedies and dramas and traditional scripted programs in the U.S. All of their growth moving forward, or almost all of it, will be international. They report earnings tomorrow. 6.2 million of the projected 7 million new customers are supposed to come from outside of the U.S. So you've seen a dramatic scale up in new programs from Europe, from Asia, from Latin America, even from Africa and the Middle East. I think you'll see more of that moving forward.
Bloomberg's Lucas Shaw, thanks for joining me. And I want to stick with Netflix here because as we talk about their new content strategy, we look ahead to the company's third quarter earnings report with Dan Morgan. He's the senior portfolio manager at Synovus Trust Company, and he joins me now from Atlanta. So Dan, I want to come and take a look at a chart here that I'm showing in my terminal for our Bloomberg customers. And basically it just shows the drop off in net subscription additions. Is this your biggest concern when it comes to Netflix earnings?
Well, Taylor, as you know, in the second quarter, it was a bit of a disappointment in terms of missing estimates in terms of subscribers. As your other guest was saying, we're looking for 7 million on this upcoming quarter, third quarter, which will be about 6.2 million international, about 800,000 domestic. So really the driving force, obviously, is subscribers. The other thing, Taylor, we have to bear in mind is this is going to be the last quarter, this third quarter, that we don't have the competition really coming in, right? We've got Apple at $4.99 a month, and we have Disney at $6.99 a month. They're both going to be releasing those new services in the month of November. So this is going to be the last kind of pure play quarter. So after this, it's going to be full on in terms of competition.
Dan, exactly. So when that competition comes online in the coming months, what do your estimates say about the drop in shares, the drop in top or bottom line estimates that when you look at the fundamentals of Netflix change given the new competitive environment?
Well, I don't know, Taylor, if they change quite yet. I mean, we have to see if people are going to drop Netflix and go to Disney or pick up Apple or so forth. It could be what most people are kind of projecting, which is kind of a soft change, which is that most people will maintain Netflix and then maybe add Disney or another service down the road. So I don't think it's an either or where we've got to come in, Taylor, and reduce our estimates in terms of subscribers, reduce our earnings and our profit expectations going forward. I think it's more of just let's see how this impacts the numbers and go from there. So I still think you're intact fundamentally with the Netflix story.
How worried are you about cash burn? If you come and take a look at another chart that I'm showing here in my terminal, you're looking at a company that on an annual basis goes through $3.5 billion of negative free cash flow. How much of a headwind is that for the stock?
Well, Taylor, the reason why cash flow is important, and coming into this third quarter, the estimate is about 910 million cash burn. The reason why it's so important is, think about this. If they're burning through cash and they don't, and a lot of it's going into content, right? We talked about the huge content, 15 billion for the year, 17.5 billion for next year. So if you think about the cash burn, they've got to then have money coming on back on the balance sheet. How do they get there? They issue debt. They've got about 12 billion in debt right now. That's expected to continue to increase. So as they work through the balance sheet and pull money out of their money market or cash area through the cash burn, then they got to come back and issue more debt to counter that, to keep the content going. So it's a fierce cycle for them. So obviously we're always focused, Taylor, on how much are they burning on the quarter? Will they have to issue more debt? How long will the cash in the balance sheet be able to sustain themselves?
Dan, I take a look at your notes, and we also push forward to IBM earnings, which will come in less than, it'll come to tomorrow, I should say. You're looking at a top and a bottom line decline on a year-over-year basis in the quarter. What are you looking for that drives those declines?
Well, you're right, Taylor. I mean, we're looking for, what, a 2.7 drop in revenues, around a 22% drop in earnings per share. We already had Accenture come out last week and say there was some slowness in their international finance area. They're very similar in terms of the service model that they use. And again, you know, until this Red Hat acquisition gets fully integrated, we're looking for negative impact to earnings for 19 and 2020. Really not till 2021 do we start to see the blossoming of the Red Hat deal, supposedly, right? So until then, they're still kind of stuck in that enterprise mainframe service business, which is very competitive, and they've been, as you say, negative growth on the top and bottom line. So we still have kind of a wait and see attitude on IBM.
You believe that this stock is undervalued. Why isn't it being rewarded by conserving cash? They've slowed down those dividend increases. They've slowed down on the share buybacks to conserve cash. Why aren't they being rewarded for that?
Well, you think they should be, because they pay a huge dividend, right? And the technology sector traditionally doesn't have huge dividend stocks, right? They're usually, you know, Apple is one that has a decent dividend. But I mean, so you would think that the value investors would migrate towards the IBM story. I think what it's kind of showing, even though they're conserving cash and not doing the buybacks, is there is some skepticism on the street whether this hybrid cloud strategy is going to pay off for them. And I think that's why you're still seeing the stock somewhat depressed, and you're still seeing it paying a massive dividend without a lot of value guys going to the name and driving the stock price up. So again, Taylor, it's a wait-and-see story based on the Red Hat news.
It's an earnings segment for us. That was Synovus' Dan Morgan. Thank you for joining me. And it's never too early to start your holiday shopping. Google unveiled new products Tuesday at its annual event in New York. Stick around for our conversation with Rick Osterloh, Google Senior Vice President of Devices and Services. That's next. This is Bloomberg. Google has unveiled its newest smartphone alongside several new smart home devices. That's at its annual hardware event in New York. The event comes on the heels of other product announcements from rivals Microsoft and Apple ahead of that crucial holiday shopping season. Bloomberg's David Westin spoke with Rick Osterloh, Google Senior Vice President of Devices and Services, a little earlier.
We're focused on trying to build the best possible Google experience. And so we bring the latest innovations that the companies are working on to our users. Pixels have always been great with camera, and that's where some of our latest research can really kind of come to light. We have the awesome photography experience, so we added to that today with a great zoom experience and a number of other tricks we're doing with machine learning and computational photography. We also have a new Google Assistant that's running on these devices. It's fantastic. The speech model's running on the device, so it's really fast. It has a new UI that's really simple to use. And so, you know, we think this kind of thing is what's going to bring help to our users, and we think a lot of people will like it. So hopefully we'll get some good traction with it.
Talk to us about price, if you can. I mean, how much are you going to compete on price with some of those competitors?
Well, Pixel 4 will start at $799, and so I think that's about in the range of most flagship phones these days. We also offered a new range of products called Pixel 3a that offers a lot of the great photography experience and access to the Google Assistant at a much lower price point. That starts at $399, and so we think that portfolio appeals to people who are looking for a great affordable phone as well as a really premium flagship phone.
So talk to us about that Google ecosystem, if I can call it that. How open or closed will it be? Because we had this works with Nest phenomenon that I think you've cut back on, haven't you?
Well, what we're doing is we're migrating all of our developers to the Google Assistant developer program, and that's so that we have one standard interface in how you interact with Google services for the Assistant. And of course, Android, the fundamental system that our phones are built off of, has been open since its inception, and I think that's one of the key characteristics of it, is so many people can build a great product line off of Android, and it's been wildly successful.
There's talk about possibly an acquisition of Fitbit. Are you in the acquisition business right now? Does the antitrust inquiry allow you to look for things to buy?
Well, we don't comment on any kind of speculation about acquisition, so I'm afraid I can't comment.
But you're not out of the business of looking at them.
Oh, I mean, we always are looking at strategic options, so, that'll continue to be a part of our strategy.
So talk about privacy as well. As we move into this world of the Internet of Things, and we have increasingly, I certainly do at my house, have a connection with Nest and things like that. There's a lot of concern about privacy and about whether, in fact, we can really trust our data. How do you reassure a customer that, in fact, it's not being used for purposes they wouldn't want it used for?
Well, as we mentioned today, privacy and security are at the core of everything we're doing. And in the past few weeks, the company's made some really important announcements about how we give users options to manage their privacy. Google's always wanted to make sure users are in control and they have clear transparency into what is going on with their data. And so now you can go to your Google account, you can see what's happening in your web and app activity. Same thing with your YouTube history and location history. There's really easy settings to delete data automatically, to turn on any information that's collected. And so users really are in control and can change what they want. And with products in the home, obviously this is even more important because these are products that are in your day-to-day life. We want to make sure we're taking special care with users' information. We usually offer simple off-on switches so that you can turn things like cameras and microphones off, make it really easy for people to see. We also have indicator lights to let you know when something's recording. And we also just added a great new capability, Google Assistant, where you can delete data just by saying, hey, please delete the data from the past day, and it'll go ahead and do it for you. So, we're very focused on engineering great privacy and security solutions for our users, and that's going to be an enormous focus for us going forward, too.
That was Google's hardware chief, Rick Osterloh, speaking with Bloomberg's David Westin. And later in the show, we'll hear from Ivy Ross. That's Google's Vice President of Hardware Design. And coming up, he turned around Target and made the Apple Store the place to be. His new company, called Enjoy, we hear from Ron Johnson just ahead. And later, our exclusive conversation with David Marcus, the man leading Facebook's foray into cryptocurrencies. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Now, when you think of e-commerce, your first thought is you order a delivery from a company like Amazon, and then the package arrives, and that's pretty much it. But 4 years ago, a company called Enjoy began looking to change that whole experience. So when you purchase on Enjoy, you also get a representative who visits your home, helps you set up the new technology with the goal of helping you get the most out of your purchase. Enjoy was founded by retail veteran Ron Johnson, who helped make Target a cool place to visit. And while an exec at Apple, he was the driving force behind the Apple Store and the Genius Bar. He joins me now. So first, let's talk about Enjoy.
Sure.
What is it? How does it work?
Yeah, it's really simple. You know, when I was at Apple, we built a new channel for Apple, the Apple retail store, and it's become a great way for Apple customers to buy, and it also created a gold standard for buying Apple products. We're now in a world where we've been buying e-commerce, you know, shopping on Amazon for about 25 years, but all it does is get to the door. What Enjoy does is delivers a retail experience in your home by going through the door. So if you order, for example, a new iPhone from AT&T, in the shopping cart it used to pick shipping, now you pick ready to go, which is another word for enjoy. And one of our trained experts, full-time employees, will bring not only the product you want to buy, you'll have others you can choose, but they'll bring a full retail experience into your kitchen or your family room.
So how does your business model work? Does the consumer pay for it, or do your partners pay for it?
It's completely free.
Well, how do you make money?
Well, because, retail stores are expensive. You know, like I was at Apple, when you build a store, you have to build out the store, you pay rent, you hire lots of employees, you have to constantly update the store. That costs a lot of money. We now just focus on the experiential part of the retail experience. Imagine if you could take that experience you have at the Apple store, just a person and the product, and transport that into your living room. That'd be a lot lower cost to deliver. And for a lot of companies, you know, in the physical world, premium products invest a lot in their last mile, which is the store. In the online world, we all have the same last mile. It ends up at the doorstep, and the only question is how fast it gets there. Now we go through the door.
So you just closed a new funding round.
Yes.
What are you doing with the money?
We are expanding. So we just announced last week that on October 29th, we'll be in Toronto with a great partnership with Rogers. Rogers is the leading carrier for the Canadian market. We also have been expanding in the UK. We now serve over 60% of the households in the UK through a partnership with British Telecom. And so we're just trying to build out our business, expanding to new countries, new products. It has been really fun.
You've brought up Apple a few times, so I'd be remiss if I didn't mention some of the recent concerns about the store. Customers say that it feels more about the brand and not so much about the consumer.
Sure.
How do you respond to that?
You know, that has not been my experience. You know, 2 weeks ago on a Sunday, I walked into my local Apple store, knocked on the door, didn't know the employees. I was able to get a new iPhone, activated, set up on the spot, great accessories. Last Friday I was in New York City. I got up early. I went down and went through the new Fifth Avenue Apple store. It's the nicest store I've ever been to of any type. So I think Apple's doing a lot really great. Retail's hard though, it's detail. And when you have busy stores, you're not going to be perfect. But I know everyone at Apple's doing their best to deliver a great experience every time.
You talk about retail, you're also at JCPenney, for example. What do you make of some of these, just the shift in the general landscape as you take a look at the retailers? Companies like JCPenney struggling, and then you have other companies like Walmart really getting it. How do you differentiate yourself?
Customers are really savvy, and they want newness. They want newness in products they buy. They want newness in shopping experiences. So companies that are kind of in the middle, that haven't been updating their stores and their websites and their product, I call tired. And the customer doesn't like to go to tired retail. You know, they want things that are new and exciting and vibrant. We're in a world now, though, where we are post-digital. You know, the disruption from online shopping is over. All of the great physical retailers that have figured out how to compete, their stocks are at all-time high. Target, Walmart, Best Buy.
And then there are,
well, because they've got advantages built in. You know, if I'm a Target customer, I can order online and have it delivered to me. I can just drive and pick it up if I want to get it now. I can pick it up and go to the store. I can shop the old-fashioned way. Even in the store, there's lots of technology deployed. There are more places to check out on your own now, just with easy scanning, than standing in line. So the retail stores have fought back, and so the better stores have never been better. But the problem is we're overstored in the country. So a lot of these mid-large retailers like Macy's and Penny's and Sears, and they don't really have a great future because it's hard.
So we'll give you the last word on
Sure.
Enjoy. What's the next thing you're going to take the company?
Well, the next thing will be next year when you will see all of these Enjoy mobile stores driving around town. And we'll go, where were they? Were they hiding in plain sight?
Mobile stores
mobile
driving
stores,
around.
everyone will see us next year.
Wonderful. That was Ron Johnson, the CEO of Enjoy. Thank you for joining me. Now, once a jewelry designer, Ivy Ross now leads Google's culture of design as vice president of hardware design. I spoke with Ross earlier from that Made by Google event in New York about the company's philosophy in product design and sustainability.
Coming late to the game a little bit in hardware, it gave us the ability to stand back and really think about how to differentiate and be authentic to our brand. And the words we came up with were human, optimistic, and bold. So for us, the word human is about not just how something looks, but also how it feels. So making sure that all of our products, when you hold it in your hand, it has a tactile feeling, and that's why we do a lot of our home products with fabric as speakers, because there's many ways that you can let sound through, but we felt like the tactility was really important, and also a lot of the shapes are rounded, which we feel is much more human and comfortable to hold in your hand. And this idea of optimistic is really what we do is through our color pops. So on our phone, where you'll see we usually pop the button with a contrasting color, like an orange pop on a black and white phone, and little surprises of color wherever possible is how we deliver on optimism. And bold is really trying new things, new finishes, new materials. Our first VR headset was covered in fabric and not in black plastic. So we really try and set our products aside through the tactility, the color, and the way they feel, not just how they look.
When we take a look at your Nest products, you talk about a lot of them being made from recycled products. Where are you on your goals of sustainable sourcing?
Yeah, we're really excited that this year all of the Nest products are using 100% recyclable plastic, but we also launched a new innovation, which is actually knitting the fabric from bottles that get kind of chopped up and then extruded and then knitted together, so that actually each 1 liter bottle is making more than 2 of our Nest Minis. So not only are we using recycled plastic, but our fabric is now made of recycled bottles. And we're going to continue to up the ante. I mean, design is really looking at sustainability through 3 lenses: material, longevity, and repairability. And I think we have to be constantly, when we design, thinking about all 3 aspects, and you'll continue to see throughout the years us actually addressing all of those areas.
How are you incorporating some of the concerns about privacy into how you design products?
Yeah, so privacy is absolutely on the top of everyone's mind. I mean, our goal is to continue to make it simpler for the consumer to be in control. I think it's a very personal thing, the degrees and types of privacy that people want in exchange for the function and help that the products give. So we are, from the hardware side, looking to make sure that buttons that turn things off are easy to find. And I know from the software side, we have recently launched a bunch of new privacy aspects to, again, the controls on things like YouTube and search, and really making it much easier for consumers to choose what those privacy settings should be.
That was my conversation with Ivy Ross, Google Vice President of Hardware Design. And coming up, our exclusive conversation with the man leading Facebook's foray into cryptocurrencies. We speak with David Marcus next. This is Bloomberg. Despite losing 7 partners for its Libra cryptocurrency, Facebook got the remaining 21 to sign on the dotted line Monday. For more, I head down to Bloomberg's Kurt Wagner.
Thank you, Taylor. I am joined now by Facebook's David Marcus, who is in Washington, D.C. today. David, of course, is the head of Calibra inside of Facebook and is one of the co-founders of the Libra cryptocurrency. David, thank you for being here. I know it has been a very busy week for you. I want to start with what happened yesterday. You were in Geneva for the first official meeting of the Libra Association. Walk me through what happened yesterday and what you guys were able to accomplish.
So yes, that's right. Yesterday we had our inaugural council meeting in Geneva, and it was a really awesome moment where 21 companies came together, not only companies, actually social impact partners, venture firms and others, came together and started working on not only establishing a governance model for the association, but also distributed different roles. A board was elected. I was lucky enough to also be elected at the board with 4 other amazing individuals that I'm really looking forward to working with. And the big change is that fundamentally yesterday, this project moved from being Facebook-led to being led by this association, of which we're one of 21 members now, and in the future one of 100, and one of 5 board members. So really looking forward to the next stages here, and it was just great to feel the passion and the energy in the room and the commitment from all of these parties that are now really going to work on really trying to change the status quo for people all around the world when it comes to access and cost of financial services.
Now, I know when you initially thought of this first meeting, there were some other companies that you thought might be there, Visa, MasterCard, Stripe. A lot of these companies announced late last week that they were leaving the association. Tell me what was happening behind the scenes as a lot of these announcements kind of came out around the same time on Friday.
Well, look, first I have to say, and I said this publicly, I want to thank all of these companies for coming along on the journey. When you're in the payment space, wanting to really explore something that could potentially be disruptive and wanting to lean in like this is really remarkable and is to be commended. I think, towards the end of last week, there was a lot of pressure mounting, and I totally respect the fact that, those businesses and those leaders have a responsibility to their shareholders, to their employees and stakeholders, and given that you don't need to be a member of the association to build on top of the Libra network, all of these companies will still have the ability to build on top of Libra. I understand that they don't want to do the heavy lifting by our side at this moment in time, and that's okay. We're going to move forward. We're going to add more members going forward in the next 2 quarters, and we're going to work really hard together to address all of the legitimate concerns that were raised by regulators and stakeholders around the world before this can move forward.
A lot of the companies that did leave, at least late last week, they're payments companies, they're financial services companies. Yes. Theoretically, those are companies that are familiar with the road ahead for you guys. Are you worried that they maybe know something that you're unaware of here?
No, and I want to strongly state that. I don't believe we're unaware of anything. I just believe that when your core business is in this space and you probably receive a lot of pressure not to press on, then at some point you have to make a decision on this high-risk project, because it's a project, it's an idea right now that we believe will see the light of day, but there's just a lot of hurdles that we still need to clear, and your core business. And again, you have to put your core business and your own business interests first versus a project like this that is high beta. And so I understand that given that they're in the space, that they would, receive a lot of pressure and want to prioritize their own business.
I want to talk about some of that pressure. There was a letter that a few Democratic senators sent to a lot of these companies, basically urging them not to join the association. It read in many ways kind of like a threat. I'm curious, did you take it that way when you read that letter?
Well, I don't know. What did it sound like to you, Kurt?
It did sound a little bit threatening. It was if you don't, if you join, you're going to have a tougher road ahead. I'm curious, have you been surprised, I guess, by the pushback that you've received from regulators?
No, and again, I'd say that there are 2 tracks here. I'd say that there's the engagement on the regulatory front, where we've had very constructive conversations. There are questions. Those are legitimate questions. We need to bring the right answers to those questions. Now we have the ability to do so. Since yesterday, we finally have a governance model and an association that is fully formed. It was really hard for us to speak on behalf of all of these prospective members before they became members. Now now the association can take this on and really make progress on all of these questions. But I'd say that, for these types of letters to be circulated for a thing that's an idea, a project, and telling people you should not explore innovation and a project at a time where not only here in this country, but all around the world, the core of our financial system hasn't evolved much in the last 50 years, and consumers all around the world are paying the price for it. I think we should ask ourselves whether this is the right approach if we want to really lower cost and lower the barriers of access for financial services for all of the people who deserve so much better in the world.
When you guys announced the formal association yesterday, you said that there were as many as 1,500 other organizations or companies that are interested in joining. Can you give us a sense of how soon you may be expanding the association and who might be joining you guys?
So these are the types of things that I can't, talk about anymore from Calibra, because this is now in the hands of the Libra Association. What I understand from the process that the Libra Association is now running is that they will work towards welcoming more members in the next 2 quarters, and my guess is they'll share more about new members as they join.
I know you say you can't share too much, but banks, there's been a lot of talk. Do you think that there will be any big banks joining you guys?
Well, so I want to put it out there. So we, from our standpoint, when we started this, as you've seen, we've welcomed all kinds of different companies, from existing incumbents in the payment space, and everyone who wanted to participate in this big idea of bringing to market something better than the current system that leaves so many people behind. And so, I think that. Again, I can't speak for the whole association, but I think that we would all collectively welcome banks to participate, certainly those banks that are forward-looking and are ready to try to do better on the core system for moving money around the world.
Great. Well, we will obviously be following closely. That was David Marcus from Facebook's Calibra. David, thank you for joining us. And Taylor, back to you.
Thanks, Kurt.
And that was Bloomberg's Kurt Wagner. Thank you. And still ahead, companies are promising more opportunities for women. We find out if they're keeping their word next. This is Bloomberg. A top priority for many businesses is bringing more women into positions of power in corporate America. Now, Lean-In.org and McKinsey & Company are teaming up to find out if companies are keeping up with their diversity promises. Joining me now is Lean-In.org co-founder and CEO Rachel Thomas and McKinsey's Chief Diversity and Inclusion Officer Lorena Yee. Thank you both for joining me. So, Rachel, let me start with you. What were your key takeaways from this report?
The biggest takeaway is, for years we've been talking about the glass ceiling, that imaginary, barrier, invisible barrier, I should say, certainly not imaginary, that women hit. And in reality, women get tripped up at the first step up to manager. So for every 100 men hired or promoted into manager, only 72 women are. And here's what happens. That means at the manager level, 2/3 of managers are men and 1/3 are women. And women effectively can never catch up.
And Rachel, how has this changed, Lorena, I should say, how has this changed from previous years? As you've looked at this study, does 2019 bring us anything new when it comes to that managerial position?
So we've had this first step up to manager gap for a long time, but I think we're putting a huge spotlight on it because, as Rachel was saying, this is where we lose that qualified supply of women leaders. And so oftentimes HR leaders are asked, why aren't there more women candidates? Why aren't you able to put forward more women? Well, if you don't promote them at the very first step, you shouldn't be surprised that they're not there later.
And have you found big disparities in tech versus other broader sectors?
Definitely different sectors look different. But the big themes that I think are really important is whenever we talk about the lack of representation, people usually say, oh, women are opting out, aren't they? And for 5 years in a row, 600 companies, 22 million people, we see that women are not opting out. We also know women are speaking up. They're asking for raises and asking for promotion. So a big part of our message is women are doing their part. So now the question is, what can companies be doing?
Okay, so Lorena, how do we fix this problem?
Well, the first thing is you actually look to see what's working. And this year we have one thing that's working very well. And in a world where for the last decade or two we haven't been able to say all that much positive news, this year we see that there are more women at the top. So for the last 5 years, as we've been doing this report, we've seen a 24% increase in women at the very top table, making the most important decisions and guiding companies and being a role model for all of those women who want to rise up. So that's the good news. And then you say, well, what did companies do right? Because they must have done something. And it's a lot of practices that we talk about, and we can both discuss these, but there are things like, do you have unbiased reviews? Do you have women on slates? Are you being a sponsor and providing those opportunities for women to climb up and succeed?
What's the best way to fix the culture if there's a culture problem at a big company?
So we found this year that employees care about two things. They care about opportunity for themselves, which makes sense, right? I care about my own opportunity. But here's the interesting part. They care about fairness. They want the system to be fair for everyone. And that goes from white men to black women. Everybody cares deeply about fairness. So if companies use being fair as their true north, not only are they going to get better outcomes in their pipeline, they're going to have happier employees.
Lorena, finally, is there a way to incentivize companies? Or is there data or statistics that show us improvements on the top or the bottom line of a company if there is a female manager, if there is a female on the board of directors? What does the data tell us?
The data tells us two things. One is that if you have more diverse teams, either racial diversity or gender diversity, profitability is higher. So full stop. That's the big case. But it also tells us that companies today, more and more senior managers are being held accountable for gender parity, and that's great news.
We could go on forever. Thank you so much. That was wonderful. My thanks to Rachel Thomas of Lean In and Lorena Yee of McKinsey. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.